Something shifted this week, and most people missed it completely. Not because the information wasn't available, it was. It's been sitting in plain sight, in Senate committee records, in Federal Reserve communications, in the CPI data the Bureau of Labor Statistics quietly released. But the financial media was busy covering the noise, the earnings beats, the political theater, the headlines engineered to keep retail investors focused on everything except what actually matters. What actually matters is this: the most significant transition in Federal Reserve leadership in over a decade is now underway. A new inflation print has just landed that changes the calculus on interest rate policy. And if you hold silver, or if you've been watching silver from the sidelines, the next 72 hours may represent the narrowest window you'll have to understand what's coming before it arrives. This isn't a prediction. This is a pattern recognition exercise, and the pattern is unmistakable. Let's start with the Federal Reserve itself, because that's where the entire story begins. Jerome Powell has been the chair of the Federal Reserve since February 2018, 7 years, through a pandemic, through zero interest rates, through the fastest rate hiking cycle in 4 decades, through quantitative tightening, banking crises, and an inflation surge that the institution publicly admitted it misread. Powell's tenure has been defined by the tension between institutional independence and political pressure, a tension that never fully resolved, that simmered beneath every press conference, every policy statement, every carefully worded FOMC minute. That tension is now resolving, publicly, irreversibly. Kevin Warsh. If you're not familiar with that name, you should be. Warsh served as a Federal Reserve governor from 2006 to 2011. He was, at one point, widely considered the frontrunner for Fed chair before Janet Yellen was appointed in 2014. He's a former Morgan Stanley executive. He's closely aligned with market structure thinking, the idea that the Fed needs to be more responsive to financial conditions, more attuned to the signals markets are sending, rather than lagging behind them with blunt rate instruments. He has been publicly critical of the Fed's communication strategy, its pace of action during the 2021 inflation surge, and its institutional insularity. Warsh is also someone who has, in various capacities, advocated for a more rules-based monetary framework, a significant philosophical departure from the discretionary approach Powell has embodied. His confirmation is moving through the Senate. That process is not symbolic, it is real, and the institutional implications are enormous. Here's why this matters more than most analysts are acknowledging. When a new Fed chair takes over, especially one with a distinct philosophical orientation, the market doesn't wait for the first FOMC decision to begin repricing. The market reprices expectations immediately. Because markets are not reacting to what the Fed does, they are reacting to what the Fed is expected to do over the next 12 to 18 months. The chair is the primary signal of that expectation. Warsh has signaled, through his public statements and his institutional associations, a preference for faster policy normalization, meaning getting rates down closer to neutral more quickly, combined with stronger rules-based frameworks that limit the Fed's discretionary latitude. That combination, if it becomes policy, has profound implications for real interest rates. And real interest rates are the single most important variable for precious metals pricing. This is not complicated. When real interest rates, meaning nominal rates adjusted for inflation, are high, the opportunity cost of holding gold and silver is also high. You're giving up yield to hold an asset that pays nothing. When real interest rates fall, either because nominal rates drop or because inflation rises faster than rates fall, the opportunity cost of holding precious metals collapses, and capital flows into hard assets. We are potentially at an inflection point where both forces are moving simultaneously, and the May 15th CPI print just confirmed it. Let's talk about that number, 3.8%. Year-over-year consumer price inflation, as measured by the Bureau of Labor Statistics, came in at 3.8% on the most recent reading. That number needs to be understood in context, not just as a headline figure, but as a signal about where we are in the monetary policy cycle. The Federal Reserve's stated target is 2%. 3.8% is nearly double that. And here's the critical point. This is not 2% overshoot territory anymore, where the Fed can credibly argue it's converging on target. This is persistent overshoot. It's the kind of persistence that, historically, has forced the Fed's hand, either into continued tightening or into an acknowledgement that the 2% target may not be achievable without inducing a recession that the political environment will not tolerate. That's the trap, and it's been closing for months. If the Fed holds rates at current levels while inflation runs at 3.8%, real interest rates are being compressed. The nominal rate may look restrictive, but if inflation isn't falling, the real yield on holding cash or treasuries is eroding. That erosion benefits hard assets. Gold understands this. Silver understands this even faster when industrial demand is simultaneously rising, because silver sits at the intersection of monetary and industrial dynamics in a way gold simply doesn't. If the Fed begins cutting rates, either because a new chair signals a more accommodative posture or because economic data softens enough to justify easing, real interest rates fall further, and the case for silver becomes even more structurally compelling. Either path leads to the same destination. That's not an accident of circumstance. That's the result of a decade of monetary policy that created a situation where the exit options are all inflationary in different ways. Slow tightening means inflation persists. Fast cutting means inflation reignites. The denominator, the purchasing power of the currency, is under pressure from every direction, and silver is priced in that currency. Now let's go deeper, because the CPI number alone isn't the full story. The composition of that 3.8% matters enormously for where things go next. Services inflation remains stubbornly elevated. Shelter costs, which represent the largest single component of the CPI basket, have been slow to decelerate because the lag between actual rent changes in the market and what shows up in the official data is roughly 12 to 18 months. What that means is that the official CPI has been showing shelter inflation that reflects leases signed in 2023, a period when rents were already declining in many markets. As those older leases roll off and more current data enters the calculation, there's a mechanical case for shelter disinflation. But that disinflation is competing with services inflation in healthcare, insurance, and education that is accelerating, not decelerating. Goods inflation, which went deeply negative in 2023 as supply chains normalized, has begun to turn back positive. Part of this is tariff-related. Part of it is a reversal of the disinflationary goods impulse that gave the Fed cover to declare progress in 2023. That tailwind has become a headwind. What this means for the Fed, and for whoever is sitting in the chair seat going forward, is that the disinflation narrative that dominated 2023 and early 2024 is not the story anymore. The story now is whether inflation becomes entrenched at a level meaningfully above target, and if it does, the historical precedent is not comforting. The 1970s are an imperfect but instructive analogy, not because history repeats mechanically, but because the structural dynamics, energy price volatility, geopolitical fragmentation, fiscal expansion during inflationary periods, and a Fed that prematurely declared victory on inflation before it was truly defeated, bear uncomfortable resemblance to what we are navigating now. In that era, silver went from under $2 an ounce in the early 1970s to nearly $50 by January 1980. That is not a projection. That is documented historical fact. The drivers were real interest rates turning deeply negative, dollar debasement concerns, and an industrial demand base that was growing faster than supply. Sound familiar? The current silver market has its own distinct characteristics that make a direct comparison misleading in specifics, but instructive in principle. Supply dynamics today are tighter than they were in the 1970s relative to demand. The solar energy build-out has created a structural industrial floor under silver demand that didn't exist in that era. The silver-to-gold ratio, currently elevated relative to its historical average, suggests that if precious metals broadly are being repriced upward, silver historically closes that ratio gap with velocity. Let's talk about that ratio for a moment, because it's one of the most misunderstood tools in precious metals analysis. The silver-to-gold ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. When that ratio is high, meaning silver is cheap relative to gold, it has historically been followed by periods where silver outperforms gold significantly. Not because the ratio mean reverts automatically, but because the conditions that drive it to extremes tend to resolve explosively. Silver gets suppressed during risk-off environments when industrial demand concerns dominate. When monetary concerns then overlay the picture, when the currency itself becomes the thing people are worried about, silver catches up. Fast. We are at a historically elevated silver-to-gold ratio right now. That doesn't mean the ratio will compress tomorrow, but it means that if the macro environment tilts in the direction that this Fed transition and this inflation data are suggesting, silver has significantly more kinetic energy stored in that ratio compression than gold does. This is the fundamental asymmetry that silver owners understand, and silver watchers are beginning to recognize. Now let's bring this back to the leadership transition and why the timing is so compressed. When a new Fed chair is confirmed and takes office, there is a period, typically measured in weeks, not months, where markets are actively repricing what the new monetary policy regime means. This repricing happens across asset classes simultaneously. Bond markets move first, because they are the most directly sensitive to rate path expectations. Currency markets move in tandem. Equity markets follow as the discount rate assumptions embedded in valuations shift. And commodities, particularly monetary commodities like gold and silver, move as the real rate implications become legible. That repricing window is also the window where retail positioning typically lags institutional positioning by the greatest margin. Institutions begin moving before the confirmation is complete because they are pricing probabilities, not certainties. By the time the confirmation is announced on the evening news and the financial commentary catches up, the first phase of the repricing has already occurred. This is not a conspiracy. This is simply how markets work. Information is priced continuously, not discretely. The gap between when something becomes institutionally legible and when it becomes publicly discussed is where the largest price movements happen. The 3-day window referenced in this analysis is not a precise countdown. It's a framing device to communicate something real, that the conditions for a significant repricing of silver are not months away, they are in the immediate term. The Fed transition is happening now. The CPI data is live. The real rate compression thesis is not theoretical. It is playing out in real time in treasury markets, in gold's behavior, and in the technical structure of silver itself. Let's look at silver's technical position, because the chart tells a story that reinforces the macro narrative rather than contradicting it. Silver has been consolidating in a range that, from a classical technical perspective, has the characteristics of accumulation rather than distribution. Volume behavior during pullbacks has been lower than during rallies, a signature of institutional buying into weakness rather than selling into strength. The metal has tested and held key structural support multiple times. Each test that holds adds weight to the level, making a break below it less likely, while simultaneously compressing the spring for a move higher. When breakouts occur from extended consolidation periods in silver, they tend to be non-linear. The metal doesn't gradually trend out of consolidation the way a blue-chip equity might. It moves in sharp, fast impulses that leave most observers reacting rather than anticipating. The 2020 move from $12 to $29 in approximately 5 months. The 2011 move from $18 to nearly $50 in approximately 8 months. These are not smooth uptrends. They are discontinuous moves driven by a cascade of positioning, sentiment, and fundamental repricing that compound on each other. The setup that precedes those moves looks recognizable right now. That doesn't guarantee the outcome, but it should command attention. Let's also address the industrial demand side of this story, because silver is not purely a monetary metal, and the industrial narrative is strengthening independent of the macro picture. Solar panel manufacturing has become the dominant growth driver of silver industrial demand. The silver content per solar panel has been increasing, not decreasing, as panel efficiency requirements push manufacturers toward higher silver loadings in certain cell architectures. Global solar installation capacity continues to expand at rates that most forecasters have consistently underestimated. The Silver Institute's data shows industrial demand for silver reaching record or near record levels in recent years, with solar as the primary engine. This matters for the supply-demand balance in a way that is distinct from the monetary story. Even if you set aside inflation concerns entirely, even if you stipulate that the Fed gets monetary policy exactly right and inflation returns to 2% smoothly, the industrial demand growth curve for silver is structurally bullish, independent of those factors. Mining supply is not expanding fast enough to meet the demand trajectory implied by the energy transition. Primary silver mines are capital-intensive and have long development timelines. The low silver prices of the 2014 to 2020 period suppressed exploration and development investment. The projects that weren't funded in that period are not producing silver today and won't be producing silver for years. The supply response to higher prices is slow. The demand response to the energy transition is not slow. It is relentless, and government policy accelerated across multiple major economies simultaneously. When you overlay monetary tailwinds on an already tight physical market, the dynamics become self-reinforcing in ways that can move prices faster and further than either factor alone would suggest. Now, let's address something directly, because if you've watched financial content before, you've heard versions of this argument. Silver is always about to explode. The Fed is always creating conditions for precious metals. The charts are always setting up. And yet silver spent years underperforming, years consolidating, years frustrating the people who believed the thesis. That frustration is real, and the skepticism it generates is legitimate. So let's be clear about what this moment does and does not represent. What this moment represents? A convergence of macro factors: Fed leadership transition, persistent above-target inflation, real rate compression dynamics, an elevated silver-to-gold ratio, tight supply-demand fundamentals, and a technical structure that has historically preceded significant moves, happening simultaneously. Each of these factors individually has been present before without triggering a major move. The coincidence of all of them together is rarer and historically more consequential. What this moment does not represent: a guarantee. Markets are not deterministic. Policy outcomes are uncertain. Geopolitical developments can shift the picture rapidly. The timeline can be wrong even if the direction is correct. People who position in silver must understand that being right about the thesis but wrong about the timing can be deeply costly if they're using leverage or capital they cannot afford to have illiquid. This analysis is not a trading recommendation. It is a structural framework for understanding why the next phase of the precious metals cycle may be different in character from the years of sideways frustration that preceded it. The difference in character comes down to one thing: the Fed story has changed. For the past several years, the dominant narrative was a Federal Reserve committed to bringing inflation back to target, even at the cost of economic pain. Paul Volcker's ghost was invoked regularly. The credibility of the institution was the message. That credibility functioned as a ceiling on precious metals, because if the market believed the Fed would do whatever it took, the inflationary scenario was bounded. That ceiling is cracking. Not because the Fed has abandoned its mandate, but because the political environment surrounding monetary policy has shifted in ways that have not been seen in modern central banking history. The pressure on Fed independence, from executive commentary, from the personnel transition now underway, from congressional skepticism about the institution's management of the 2021-2022 inflation surge, is structurally different from past episodes of political tension around monetary policy. Markets price institutions, not just policies. When the institution's independence is perceived as eroding, even partially, the risk premium on hard assets increases. That premium doesn't require an actual policy error. It requires only the credible possibility of one. Kevin Warsh may be an excellent Fed chair. He may navigate this environment with skill and credibility. But the transition itself, the process of replacing Powell, reconfiguring the institution's leadership, and establishing a new policy framework, is a period of elevated uncertainty. And uncertainty about monetary institutions historically benefits gold. It benefits silver even more in the ratio compression phase that follows the initial monetary repricing. Think about what this looks like from the perspective of a central bank in an emerging market economy. You are holding dollars and dollar-denominated assets as your primary reserve. You watch the Federal Reserve go through a politically charged leadership transition, while inflation remains significantly above target. What is your instinct? You diversify. Slowly, quietly, at the margin, because you cannot sell dollars aggressively without destabilizing your own currency. But you accumulate gold. You look at silver. You move toward assets that don't carry the counterparty risk that dollar reserves carry. Central bank gold buying has been at historically elevated levels for 3 consecutive years. That trend does not reverse quickly, and the conditions that are driving it, dollar reserve concentration risk, geopolitical fragmentation, Western sanctions precedents that demonstrated reserve assets could be frozen, are not improving. They are intensifying. Silver benefits indirectly from this dynamic through gold, and directly through the ratio compression mechanism as monetary demand strengthens. 72 hours. That framing deserves a direct explanation because precision is important. The 3-day window is not about a specific price target or a precise catalyst. It is about the information environment. Right now, in this specific moment, the confluence of events, the Warsh confirmation process, the CPI print, the technical setup in silver, the real rate compression dynamics, is legible to people paying close attention. In 72 hours, it will be more widely discussed. In a week, it will be mainstream financial commentary. In a month, it will be consensus. The progression from legible to attentive to widely discussed to consensus is the progression that drives price moves. By the time something is consensus, the price has usually moved to reflect it. The question is always where you are in that progression when you act. This analysis is situated at the beginning of that progression. The data is fresh. The narrative hasn't solidified. The mainstream financial commentary has not yet connected these dots into a coherent precious metals thesis. That window, between when the pieces become available and when they become assembled into a dominant narrative, is the window that historically offers the most asymmetric opportunity. So what does this mean practically for someone who already owns silver? It means the thesis is being validated by macro developments that are independent of your position. The Fed transition is not something you could have predicted perfectly. The CPI print is not something you engineered. They are external confirmations of the structural case you made when you accumulated. The instinct that told you to hold a monetary metal in an era of fiscal expansion and monetary uncertainty is being vindicated by the data in real time. What does it mean for someone watching from the sidelines? It means the window between thesis legible and thesis consensus is closing. Not because silver is about to go to the moon on Tuesday, that kind of prediction is not supportable and this analysis doesn't make it, but because the structural setup that has been building for months is now being overlaid with catalysts that compress the timeline. The longer you wait for certainty, the more of the move you surrender to the people who acted on probability. That's the nature of asymmetric assets. They don't give you certainty before they move. They give you structure and signal and a window, and then they move. The Federal Reserve is in transition. Inflation is running at nearly double the Fed's target. The new leadership at the central bank carries a philosophical orientation that markets will price as more accommodative in the near term. Real interest rates are being compressed in the background, while the headline commentary is still focused on whether the Fed will cut once or twice this year. Silver sits at an elevated ratio to gold, with a tight physical market, record industrial demand from the energy transition, and a technical structure that has historically preceded major moves. These facts are not opinions, they are conditions, and conditions, in markets, have consequences. Most people will read about those consequences after they've already occurred. They'll see the headline, "Silver breaks to new highs, precious metals surge on Fed transition concerns, CPI data drives hard asset demand," and they'll feel that familiar mix of regret and recognition. The feeling that the information was there, that it made sense in retrospect, that the pattern was visible if you'd been paying attention. You are paying attention, right now, in this window. What you do with that attention is, of course, entirely yours to decide. But the window is open, the data is live, the transition is real, and silver doesn't wait for consensus.